All right, let's get started. Hi, everybody. Thank you for joining Solar Connect 2025 Insights to a New Era. I'm Brent Thurgood, head of people at Enerflo, and we're really excited to have everybody here today. We have 6 engaging sessions lined up, each designed to provide cutting edge insights into the solar industry. We have been asked to share this Roth Capital disclosures. So just a quick intro to that, as you can read, Roth makes market shares in those following companies and has received compensation in the last 12 months for non-investment banking securities related services from Emeren Group Ltd. There are shares there, as you can see, and they may be subject to the Securities Exchange Commission penny stock rules. Wanted to make sure everybody saw that. We do have Phil Shen from Roth, who I'll introduce shortly. Okay. All right. We're kicking things off today with a deep dive into where the industry is headed, the trends shaping the market, and the opportunities on the horizon. Get ready for some serious insights as we unpack what's next for solar 2025. Today, we are joined with an awesome panel. We have Chris Collins, founder of Ohm Analytics, Phil Shen, managing director and senior research analyst at Roth Capital, and my boss, Spencer Oberon, Enerflo co-founder and CRO. So let's launch a poll. We want to see, what do you see as the biggest factor influencing solar industry growth in 2025? Take a second, pick what you think. I'll end the poll. We'll take a little look. All right, lots of answers coming in. So take a look at what we're seeing. Government policy is clearly the winner for this poll on what's influencing. So I know we all want to speak to that, but thank you for everyone taking that. Of course, interest rate goes right in hand with that. All right, let me now stop sharing and going to kick it over to Spencer. Let's do some intro and anything else you want to jump in, then we'll get right in. Thanks, everybody.
Thanks, Brent. Actually, Brent's a liar. He's my boss. I just do what he says all the time.
People. That's right. All right.
Yeah. Phil, I was going to comment. I used to actually have long hair like you, and I had a man bun and everything back in the day before it was cool, but I couldn't connect it. So I couldn't, like the front hair, I couldn't get it all the way back. So I had to do a man bun here, and then I had to do one back before Ray did it on Star Wars.
Nice.
I had two. And yeah, I was cool. I was cool
share
back
some
then.
pictures.
Yeah, I'm pumped to be here with you, Phil, and Chris. I've known you guys for a long time. Phil, you reached out to us when we were just little babes in the industry, and we've had that relationship for a while. I'm really looking forward to this one. This was one of my favorite sessions from last time. You guys are so connected to the data and to the pulse of what's happening in the industry. And so I'd love to just start out with you, Chris, and have you just give us some insights on the data, and then have me and Phil pepper you with questions, and then we're going to just let this evolve and see where it goes. And just little housekeeping stuff. At 45 after the hour, we're going to open it up to Q&A to anybody for any questions that you want. And if you do want to know any of Phil's hair products that he uses to have such amazing hair, well, I'm sure that he will divulge those at that time. All right, cool. Chris, let's jump in.
Yeah, sure. I pulled together a bunch of data for this talk and wanted to get started with just table setting, where we've been and where we think we're going to be this year at a high level, but then go really deep into just positives and negatives that we're seeing in the recent data and have a lot of different data points on that. And as we go through these, I thought it'd be helpful to talk about how can an installer, your customers, Spencer, position themselves in this environment for success. I can give some anecdotes too about what I hear from installers of how they're doing it. And then also, I think Phil's got a good lens of what might change with this outlook based on the administration and the timing of those things. I think he's got a really good pulse on it. So that's how I thought we could structure the discussion. I'm going to share my screen and we can go right into the data.
Let's go.
Okay, you'll see that. Okay, great. So this is just level setting here. Market was down 25% 2024, and we have a forecast for 2025. We will release this forecast in December. it shows 4% growth. I think based on what's happened from December to now, that'll go down a bit and to maybe flat to slightly down for the year. And I know Phil has a forecast. He updates his in real time, and that's maybe negative 10%. Phil, I think, is the latest. So I think this will go down a bit. We just update our forecast quarterly. And I think a key part of the forecast is that it's back weighted a bit. So this is on the left, there is the quarter. There's a forecast by quarter.
Yeah.
And you can see year over year growth gets more positive towards the end of the year. And I think a lot of that we were banking on some interest rate cuts. So that's just level setting. Again, down 25% 2024, a little bit more stable, but still not returning to growth or significant growth in 2025. I think 2025 is a year for installers to focus on efficiency, hang in there, and be able to take advantage of the long-term trends in this market.
Did I just jump in for a second there, Chris?
Yeah,
Yeah.
let's go.
Yeah. Chris mentioned we are down 10%. Chris, do you mind going back to the first slide?
Yep.
So the way Chris and I do forecasts is dramatically different. He looks at the actual data and then tries to triangulate where that data is going. For me, the way I think about it, so as Chris mentioned, we are down 10%. We took that down on Monday from flat year-over-year growth for 2025. That was our forecast at the end of last year. And the way we go about this is we talk to a lot of big players and triangulate that way. So they are planning their businesses. These players have major market share. And it's not just installers, but we'll talk to, I don't want to say exactly who, but all kinds of people that make up meaningful market share. And so based on that, we get a feel for where things might be. So my sense is down 10% is a real possibility. And as a result, you and the audience as installers plan for yet another potentially difficult year.
So question. So Chris, just to recap, you're looking at actual historical data and then taking that and creating your projections off of that. And Phil, you're going to the actual, let's say the top 10 installers, right? And groups that are doing solar. And then you're actually just calling them and saying, hey, what are you guys forecasting for the year? So yours is based off of forecasts from the big boys and yours is based off of historical data. And we're combining those to get a holistic picture. Is that fair?
Yeah, we have I think Phil definitely relies more on the channel checks, but yeah, we do that as well. And I think we also, we have a very detailed state by state build up that we do, which we can highlight, but which looks at all things like utility rates and recent data.
I'm excited about that. I have another question just because this piqued my interest as you guys were talking. Last year at this time, what were your projections, Phil and Chris? And how close did we get to those? Do you know off the top of your head?
Yeah, thanks for keeping us honest. I think I can talk about the 2025 outlook. And the first time we released the 2025 outlook was in September and it's come down a bit. I think our original 2024 forecast was maybe down 10% or so, and ended up being a good bit worse. And I think we can actually, I have some slides to cover where how 2024 evolved, because I think there were some big surprises.
Yeah, I think you guys are both going to touch on this, right? But I'd love to know from the data and also your personal estimation over the course of the next 40 minutes, why are you guys revising downwards? And what do you think is the greatest factor it's causing that to happen? And I think we're going to peel the layers of the onion back over the next little bit and understand that more. But that's a question that's burning hot in my mind now. So as we're going through this.
Sure. Yeah. And I'll go through some of these, but I also want to leave some time for some of the green shoots.
Yeah.
Because we're seeing some positive things. But just a quick summary here. Spencer, you asked like why it's changed. And I think on the left there, you can see, I call it stubborn interest rates. I think is the biggest one. It also showed up in the recent data. I'm going to show some. I think the other thing that's weighing on the market are some of these potential liquidity issues with some larger financing companies just flowing down to installers. And then obviously the policy uncertainty. So those are negatives. On the positive side, I think we're seeing the folks that made it through this last period are on more stable footing, not like we're out of the woods. I think the stronger operators are there, are remaining, right? And so not like we're completely immune to issues, but there's just stronger folks that are remaining. We are also seeing, I'll show you some interesting data on this. California market is improving, which I think is good. Good for overall industry to see that we can go through a major change like that and eventually go back to growth. And then the biggest positive, I think, is the long-term fundamentals of this market. It's even though we've gone through this period of pain, things like utility rates, consumer interest in electrification, resiliency, those things have all gotten more positive. It's just another reason to position yourself. If you can make it through this period, 2026 and beyond will be a lot better.
I like these insights a lot. It's like how California goes, the industry goes a lot
Yeah.
of ways. It's not like a silver bullet or like a magic 8 ball, I should say. But I think it's a really good indicator. And California was struggling over the last little bit. And now that it's picking back up, I think that's some great indicators of how the market could be going now as we see that stabilization. I also have, just to echo this from our perspective, we have seen that we've had a lot of partners go out of business, like installers just shut their doors,
Yep.
right? And that does a couple of things. One, it forces the other installers and companies to operate better. When money's cheap and you can get it, and sales are just coming out your ears like the salmon of Capistrano, right? It's really easy to run a business, right? But because you don't have to run a business, you're just collecting revenue and you're just going. Now it's like the people that are great operators, those are the ones that are being exposed in a good way. And the people that aren't are also being exposed in a negative way. And it's creating more opportunity actually for our good installers are growing because of that efficiency, because those jobs got to go somewhere. There's still millions of Americans that want to save money and want to do renewable energy. And so I think this is a great opportunity for those great operators to really have a phenomenal year. Not everybody will have a great year, but I think the ones that really operate well, I think that's a really key indicator for them that this could be a good year for them.
For sure. I'll tell you, great. I get add some color into what I'm hearing from installers. So I thought I could just show some data on these big trends. I think maybe we'll take the pain first and hit some of the negatives or the uncertainty, but then want to cover some of the positives. What this is just average daily. This is actually permit volume over the last couple of years. And I think, Spencer, your earlier question, like why did the forecast go down a bit in last year? You can see in early 2024, in that green circle, we saw some green shoots. The market was picking up, but then in the summer, I think a few things happened. We had these large bankruptcies. Some of them were expected, some surprise. And then we also, with SunPower and Titan. And then towards the end of the year, we had a rate cut, which didn't really flow through. So in September, we had a rate cut, but it didn't flow through into customer facing rates for the 7-year. And so it's just been a little bit slower. So the takeaway, I guess, in January, we haven't actually released this data. This is the first time we're releasing it. So January was down 17% outside of California year over year still. I think if you include California, it's maybe 12% or so. So it's still down year over year, but it's been improving.
Interesting.
And this is some of the data by state as well. So you can see there's pretty wide discrepancies, variances across states. Texas and Florida, which are now huge solar markets, are still a little bit slow, down 22%. The Northeast, you can see the collection of states in the Northeast are doing a lot better. New York is basically flat. Connecticut's up. New Jersey, single digits. And then on the West Coast, you're seeing California, which is 2%, basically flat, which is good from recent data.
Yeah.
And then, Washington, Oregon are doing a little bit better. So I think the key theme here is that Northeast continues to do better. Texas and Florida are still experiencing some pain.
In your personal estimation, why do you think they're, from your data, and maybe you feel, why is Texas and Florida, Nevada's clear to me, that's another conversation, but Texas and Florida, why are they experiencing that?
I think they're more sensitive to interest rates. They saw the most pickup when rates declined, and they've seen the most pick. I think also they were not TPO markets, like Texas and Florida were not TPO markets, and some installers have tried to switch to TPO and are doing more there. It's gone up. Like I think Florida might be like 35-40% TPO now, and there's probably more pain installers are feeling from adjusting to that. Versus in New Jersey, where TPOs have been a big part of the market. So that's what we're hearing from installers, just like more adjustment in those markets.
Would it be fair to say, I guess from our perspective as well, like Texas and Florida, they were so high, meaning they were crushing it and absolutely destroying it. And because it's not really a TPO market yet, they're making that switch, that the drop was more dramatic than you would see in other places. And now they're building back up. So I don't really, when I look at Florida and Texas, I don't look at that and say, oh crap, Florida and Texas are down. Solar's not good there. I actually look at it and say the market corrected a little bit because it was I want to say overinflated a little bit or over indexed on those two states because they were doing really well. And now as the market has changed, but those two are really still great solar markets.
Yep, I agree. I agree. That is a very good way to position it. Also, they're very low solar penetrations. I think it's still 2% of homes in Florida and Texas have solar. And also, those are very good resiliency and storage markets. So I think, Phil, this actually came up in our last conversation. Like storage attachment rates in Texas are now 20% or so in the most recent data. And we're seeing a lot more storage there in those markets.
So I echo everything Chris was saying there. And I had a question for Chris on Texas and Florida. With rates being elevated for as long as we might, we're expecting, which is maybe through the year now.
Yeah.
What do you think is the outlook for those two markets? Do you think they've already troughed, or is there still a longer adjustment period? And then bigger picture question on the US market, where you said that there's some downside risk to your plus 4% forecast. Let's take that first question first. I'll come back to the second.
Yeah, on the forecast, it's not like downside risk. Like we haven't updated it since December, and I think we're going to update in a few weeks and it'll go down. There's obviously like more downside risk beyond, but we just don't update it on a weekly basis. So we're based on what's happened in the last few months, it'll come down.
Spencer, earlier you were asking what our forecast was at the beginning of 24. So we were forecasting in December 23, down 12% for 2024. And Chris, what did you say? The market ended up being down 24, 5%.
Yeah.
Okay. So directionally right, but magnitude was much higher.
Yeah.
Let me cover interest rates, Phil, since you asked. I think we've got some interesting slides there, just how people should think about what's happened and also what could change next year. This is a helpful chart that just lays out a few different data points. The green line is the blue bar is the solar market year-over-year growth. So you can see as rates came up, the market started to decline. The green bar is the Fed rate. So the Fed can take rates down. But the what's really important to the red line, which is a 7-year, which is basically what solar lenders benchmark off of. They don't benchmark off the Fed rate. And then the orange line is actually what's like solar financing rates, what's actually being offered. So I think the key here is that like we had some rate cuts in September and December, but that didn't flow through to the 7-year. 7-year actually went up, and that has impacted also the APR of solar financing companies. And this is a question for Phil. And I think the outlook there's a meeting in January, which I think will have less likely to have rate cuts this year. But Phil, like, this is a question for you. The 7-year could move too. So I don't know how you're thinking about that. If we don't get rate cuts, the 7-year could go down. Just question how we should be thinking about that.
Yep. So what the Fed does very much can influence and does influence where the interest rates go. And I'm not a bond guy or a fixed income guy, but I have to follow this stuff. And there's a scenario where the Fed could cut rates, but then like the Fed funds rate, but the effective interest rates, the 7-year, the 10-year, 5-year, those things could still go higher. And I don't know what the exact outlook is for rates at this point, but if you look at a lot of the White House policies and expectations with tariffs, all those things are highly inflationary. And so my personal expectation would be that rates continue to be elevated. Do they go even higher from here? You have that chart there that shows we've seen a tick up since August. I wouldn't be surprised if it continues to tick up modestly. And then from a solar standpoint, we've written that we could get a polysilicon tariff. We could get a wafer tariff. We just got this anode EDCVD tariff, which is the process was kicked off. And so we'll likely get some kind of preliminary tariffs there come April and August, or is it July and August? And so that means battery costs could go higher. And so that's just the direct supply chain, never mind the aluminum tariffs that could be coming online. Now, there are going to be questions around, are these tariffs just on the raw material or on downstream goods? And if it is on downstream goods, that could be a challenge from an inflation standpoint. So that's a long answer. There's more I could say, but hopefully that's something useful.
Yeah. Yeah, absolutely. And this is just to close the discussion on interest rates. The market's very sensitive to this. This analysis we did on sensitivity to interest rates. And so on the left there, you can see that over the last couple of years, market's gone down 34%, rates have gone up 3.65%. And so for every 100 basis points of rate movement, the market moves about 10%. And that's just one way to folks think about the market. If we do end up getting rate cuts this year, it could be a boost to the forecast in the back half of the year. So obviously very sensitive. This just puts some numbers to it.
Interesting.
So that I think that's more of dose of reality. I do have some data points I want to share on positive things we're seeing, and maybe Phil, we could chat about how installers can position themselves in this environment to take advantage of some of these positive things.
Sounds good.
So I mentioned the California recovery, and this is the volume for California. And what we saw, we're hearing it from installers that there's been a pickup, and so we actually saw that in January, where January increased, I think, +8% over December, which is not normal seasonality. So we're starting to see a bit of recovery. It's basically flat in January. And when we talk to installers, they're more optimistic in California, and they're saying we think it could be like 20% growth on sales. And so this is actually our forecast. There's a bit of noise in the numbers. And so what we've done here is broken it out between NEM 3.0 sales or installs. And so we think NEM 3.0 installs in 2025 will grow about 25%. And that's generally aligned with what I hear when I talk to large installers there. And so obviously it's from a lower base, but I think it's good. It's a good example of how the industry has been able to recover and learn how to sell storage.
Yeah.
And I hear, like Spencer, last time we were having this call, there was a lot of talk about how are people going to adjust and be able to sell storage. And there's a lot we hadn't quite figured it out. And I hear less of that now. So I think people have adjusted, and that's really positive for the market. And also you're going to see that in Illinois. Illinois has a similar change. And it's a good example of the industry being able to adjust to some of the policy changes.
Yeah, we've seen that across the board with just other software companies across the board, where everybody's invested a lot of time and resource into the battery sizing tools, battery savings calculations, all of that, so that reps can sell it better and homeowners can understand it better, the value prop. So I think as a whole, we're going to continue to see lots of investment and growth in the storage sector. Phil, you were going to say something.
Yeah, just a quick question. When you look at the NEM 3 sales, Chris and Spencer, what is the attach rate that you're seeing? Is it 80% or is it really like 95%?
I think it's 90%. Yeah, it's high.
Yep. Okay, cool. I'll flip it back. Thanks.
I'll hit some of these highlights too. We talked about some of the long-term fundamentals and what's happened to those over the last year or so. And I'll just highlight some of these. There's a huge increase in the need for resiliency. And this is a really good data point. There's actually, in 2024, there's 3 times the number of billion-dollar natural disasters versus the historical average. There's about 24, and the historical average is about 10 or 9. Really positive. Yeah, there continues to be aging infrastructure in the U.S. is $2 trillion of spend that's forecasted to upgrade that. And then there's all this on electricity demand and prices. There's all of this pressure upwards from AI and electrification. And so those are all positive. I just showed an example here. Like if you're an installer, the market's very sensitive to utility rates, and especially the state markets. And we track this. And so this is just a highlight of some of the planned rate increases across the country. And you can see like National Grid, New York, 15% for this year, Rocky Mountain Power in Utah, 18%. This is a really positive long-term trend. There's going to be pressure on this, and you're actually seeing it right now.
What I would say is this is probably one of the best selling points as an installer. Just really go into you probably do this already, but just the wide and broad price increases ahead. And a lot of it's driven by AI and power. And that's something we're following closely. And there's not enough of it for what the hyperscalers want to do. Yes, there's pricing, your costs going higher from a tariff standpoint. Rates are staying elevated, but on the flip side, the revenue side of the equation with the power prices staying elevated and going higher can be a nice and important offset.
It's interesting how AI is now playing a role in everything, meaning like not just productivity, but hey guys, your chat GPT you use, it's increasing your utility rate because people need to power their servers and do all that. And so it's really transformative in so many ways I don't think people recognize. That's
Yeah.
really great though for us in the energy sector because that's not going away. If anything, people are doubling down, tripling, quadrupling down on that. And we're going to see a lot more of this for the next 10 years.
You know,
probably.
10 years.
There are lots of opinions people have about AI, positive, negative, but the reality is power is going higher as a result. And Eric Schmidt, former CEO of Google, had an interesting or funny quote in terms of power and climate change. And he said, we should ask AI how to solve climate change and reduce the power consumption, which was a bit ironic.
Yes, it is.
But,
This is really good, Chris.
160% load growth from AI is what people are projecting. And this is just some interesting kind of sensitivities, just looking at some state markets. So just give one example. It's interesting information. Again, Massachusetts here, bottom center, lower center here. When rates went up 24%, I think in 2022, the solar market went up 54% relative to a baseline. So the market's really sensitive to interest rates. And so for installer, really position yourselves around areas where rates are going up and there's been large increases. I think that's top of
Sorry,
mind.
Chris, you said interest rates, but you mean retail rates, right?
Yeah.
Sorry, utility rates. Yes, sorry.
Chris,
Yep.
let me ask you a question. I'm an installer. ABC Solar, right? I'm starting out. How would I know and what the utility rate proposed increases are? Like, do I go to you to get this data or can I just Google it? Is there a government map? Like, how do I know who's planning on doing what, where, when, so that if I want to build my business around these rate increases and do that, how would I find that information?
We do a good job of tracking it with the lines of the solar market. It's not something you can just Google. It's embedded in rate cases. Yeah, the interpretation of those rate cases. That's not like our main focus of our business, but we do a good job of tracking it. And you can sign up for our stuff. Just this, what I showed you here, that's from our work.
That's cool.
It requires a lot of digging and interpretation. It's not necessarily out in public.
Yeah.
Bill,
If you want to do it, you should probably find a way to access your local public utility commission filings. Chris, is that the best way?
Yes, that's where it is. Yeah. But if you don't want to read 100-page PDFs, we can do that for you. And
I love 100-page PDFs. So my favorite.
We'll be helpful there.
Well, I have
yeah.
No, go ahead. Finish your thought, Chris. Then I have a question for Phil.
I have some data on, I thought we could cover some of the installer liquidity and capital markets questions.
Let's do it.
So I have that as the last thing. I think Phil can add some color there.
Let's do it.
Oh, you want to get off and frame it?
Yeah, I'll just show this one chart here, which is just tracking major bankruptcies in the industry. There's some positives and negatives to this. I think positives is that it seems to have slowed down, right? So you can see there's a lot in the middle, in the first half of 2023, after we saw big rate increases. I think that's slowed down. I don't think we're quite out of the woods yet, but again, the folks that are remaining are like in a better position. And I think Spencer, I love your opinion on this. I have a thesis that the pain that people are feeling, the pain that we felt before was mainly driven by poor operations, combined with some of the financing companies really tightening down quickly and putting people into a really tough spot. I think the pain that people are feeling now is a little bit different, where it may be an adjustment to TPO. There may be some TPOs that aren't as quickly, but it's generally like people that have tighter operations are maybe in a better spot to get through it. So I think this time's a little bit different, but we'd love your opinion on that.
Yeah, I think the pain that we're seeing now, I think there's a couple things that are going on, and I want to stay on green shoots and keep people happy, but I think that there's some things that are going to play out over the next 3 to 4, maybe 5 months. We had a lot of companies just in the industry, Enerflo, wherever, that were betting on, let's rewind a little bit. It's hard to raise money. It's hard to go out and get people to invest in your business right now with the new administration, with uncertainty around policy, with all the numbers that you guys provide the market. I want to know, is Phil telling everybody buy, or is he like hold or sell? right? So there's a lot of pieces here that have created a lot of uncertainty, and it made it hard to raise money for people to go out and grow their businesses. And so because entrepreneurs are usually growth mindset, and instead of just let's maintain mindset, we had a lot of groups last year that made some big bets on summer, right? And those big bets, some groups they hit their bets. There's a lot of groups that didn't hit their bets. So right now it's real thin, meaning I think there could be another little group that goes out of business in the next 3 to 6 months. But I think because of that, because of the cash flow constraints and issues, the issues with raising capital, and then also the downward pressure that they're getting, and then also competition for sales companies like groups, like how solar is sold, how a solar sales group is recruited and retained today is very different than it was 12 months ago and 24 months ago and 36 months ago. And because of that, you have all of these different factors that I think you're going to see some downward trends over the next 3 to 6 months. But after that, I feel like from my personal perspective, you're going to see a lot of, all right, cool. We've gone through this. Let's go. And we're going to see a lot of really good growth. But I think, so that's where I think some of the downward pressure is coming from, meaning like people aren't doing as well. I also think it has to do with, I don't know, there's a lot of fatigue out there. Like this coaster ride wasn't supposed to be 2.5 years where it was going down. And so there's a lot of fatigue. There's people that are just packing up and saying, I'm out. There's also a lot of people are in survival mode, but that's all changing. We're seeing a lot of stuff from our software, from our data, from the conversations we're having with partners. We're seeing a lot of that change. And so I'm very actually optimistic about 25. I think that you guys could, and I hope that you guys are both wrong on your predictions, because I think that we have some really good stuff coming about with the adoption of batteries. Now people understand how to sell that. TPO, for example, all of last year, right? People were trying to get TPO products integrated into platforms because you don't transact really anymore like you did with a finance company 4 years ago, 3 years ago. Okay. You could go to a finance company's portal 3 years ago and transact everything, right? You really don't do that, right? Most TPOs now today don't have a place where you go to their stuff and you transact. What they do is they integrate with us and the Solos and the Sonobis and the SubHubs and the Pipes of the world. They let us do all of that. And because of that, but it took time. It takes a lot of time. But we've gone through all of that work last year and there wasn't a lot of availability. Now there's a lot of options. They're built into the platforms. So I think that you're going to see a greater adoption of TPO, and whether the rates stay stagnant, go up or down, I think now we have a lever that we can pull that can satisfy the volume needs and to keep our people growing and in business. So.
Yeah, 100%. I agree. One thing to add to that, and I love Phil's take on this as well. When we talk to ABS investors, so the people that are buying these assets, like that market is very strong. There's record ABS securitizations. I've heard from the bankers in that space that now that we've hit this tipping point, there's more liquidity in that market. Pricing has gone up. There's just more investor interest. And so I think that's also one very positive. Maybe we see one financing company exit the market, but there's a lot of people that want to own these assets. And
I hear you guys.
Yeah.
Sorry to cut you off, Chris.
No, you got it.
Okay. I hear you, the optimism there. This has been a long downturn, 2.5 years. I was hoping and becoming optimistic at the end of 24, that 25 would be a growth year. Originally mid-year of 24, I was at plus 10% for 25. Then it went down to flat for the back half of the last year. And then now I'm down 10%.
Yeah.
And unfortunately, that's a pretty wide swing. It may not be fully right in terms of magnitude, but the directionality, I think, is something to think about. And unfortunately, I hear you guys and what you're saying. The ABS investors, think of them as the people that go to the restaurant and they're eating the cooking of Sonova, Sunrun, Good Leap, all those guys. So they are they are the financiers that work with the installers the installers then buy the modules and all this stuff. That's the raw ingredients for the food, the plates of the serving, right? So the ABS investors are the customers and they enjoy the food. It tastes good. The risk is good. The performance has been good, but the front end of the full system is rates. And then specifically for solar, it's tax equity. And that's where there might be a little bit of strain at this point. And so when you have a limit on your salt or your flour or your eggs, your ability to serve maybe you're missing a little bit of salt and you can't, it doesn't, may not taste, actually the salt is up by taste and the taste is fine. It's just certain ingredients might be missing. So you can't really produce all that you want
Yeah.
to produce. Right. And
Mhm.
so we're looking at this Nova situation.
Yeah.
So many
That was
people
going to be one of my questions for you.
are not getting paid on time or in the amounts that they want. We've been writing about this through 24. We wrote about the first series of missed payments back in February of 24, the middle of 24, and then most recently around Christmas time, extending till now. Right. And so if you want to see our research, ping me, get my information from Spencer and the Enerflo team. But ultimately, I believe the root cause of the most recent problem for them has been tax equity and the ability to get that quickly, right? And so, or on time. And now we're hearing about corporate rates, right? Not interest rates, but corporate tax rates coming down. What does that mean? That means there's less potential tax credit need, right? If overall corporate taxes come down, now this is maybe more of a marginal kind of thing, but if you look at all the different tax credit investors or buyers and then tax equity investors, some of them are sophisticated and they understand solar, and others may not. I don't want to speak too long because I know we're getting toward the end of our time here, but my point is this: as an installer, be positioned to deal with sustained tightness with cash flow, right? Diversify your financing partners. Those are some obvious things, right? But if you can avoid buying a certain thing to keep the expenses tight, do that. Continue to buckle down to prepare, make investments. If you need to become more efficient, working with Enerflo and so forth to reduce other expenses with other software platforms, that makes sense. But be wise with the amount, like the way you spend your money. And because I think the tightness might sustain for some time.
Yeah. Brent, I know it's time for Q&A. I will actually want to kick off the first Q&A unless there's anything you want to say. I want to ask Phil
Oh,
another
that's
question.
great. But those of you who are attending, you can look at the bottom of your screen and type in the Q&A and we'll try questions. Go ahead,
Sweet.
Spencer.
So Phil, I know that the way that this is my perception. This could all be wrong. Okay. But I feel like if Phil says buy SolarEdge or buy Enphase, people are buying SolarEdge or buying Enphase, right? And you've got a lot of sway in the industry. I remember the first time you came to us and you're like, hey, we want this data to tell all these people. We're like, what's on the line here? Oh, just people are going to invest hundreds of millions of dollars based off of the data you give me. I'm like, sweet. That sounds like a terrible idea for us. But it was a little nerve wracking. But when you talk to people, and maybe you can't, and if you can't answer this question, that's fine. But when you talk to people, are you telling them to hold? Are you telling them to buy? If you're telling them to buy, what are you telling them to buy?
When we talk about investment recommendations, rating is one thing, and then there's a sector view as well, right? And so in my universe, I have utility scale solar and resi solar as my two main sectors. And we haven't even talked about Trump and the GOP and a red sweep that we got and what that could mean. And we've been writing about that 6 days after the election. We published ITC could require domestic content in order to get the base 30%. And at this point, nobody really knows, but this is what some of the DC folks my contacts were telling me. It's really look for changes to come with legislation, with the ITC, the PTC, less relevant for you guys. But when it comes to changes, utility scale solar as a segment, they have the ability to safe harbor, right?
Yeah.
And so resi solar has less of an ability to safe harbor. So some of the biggest players in utility scale solar, some players were saying we're going to safe harbor for 4 years from 26 through 29. I think resi, you have to lean on as an installer, your TPO partner to be able to safe harbor. IGS has done one, others have done some, but until we get clarity, then there may be some reluctance to do that because that takes up a lot of balance sheet capacity, meaning cash and the ability to borrow. And maybe some of the TPOs can safe harbor for a year and a half. But my point is this, Spencer, when I look at Resi, coming back to your question, it's the safe harbor of the rich Biden ITC stack, which I call 30% base ITC, 10% domestic content, 10% energy community, plus 10 or 20% LMI.
Yeah.
That you might be able to have another year of that after 25, right? So you have visibility through 25, and then maybe, depending on who your TPO partner is, through a lot of 26. But then if they do change the ITC, it's a very different world, right? Like that stack could be compressed meaningfully. And we wrote recently that the ITC and PTC could be phased down starting at year in 25, which means what does that look like? And nobody really knows, but some of my contacts were telling me 30% year for the base ITC in 25, maybe steps down to 20% in 26, 10% in 27, then zero. I was hearing zero. So coming back to the question about stocks, the Resi outlook was challenged. And then we look at who's positioned better versus others in the universe. And so we have 4 key stocks: Enphase, SolarEdge. Enphase is much better positioned relative to SolarEdge, in my view, from balance sheet standpoint, all this stuff.
Yep.
As relates to Nova Run, we technically have a buy on both. Don't worry about that. The reality, we've been talking about the cash issues for Nova for a while. The reality is Run has been outperforming Nova. And for now, Run is, I think, likely going to be able to access tax equity better insofar as I can see. So they might be better positioned. Nova has a pretty deep hole to dig out of at this point. So they have to deal with the reality, and we'll see if they can do that. I still think and see a path for them to get out, but it's a challenging one.
Thank you. Brent, you got some questions you want to sling out there, or do you want us
There's one question in the Q&A, and I don't know if it was when you were talking, Phil, about the recipes, but it was your take on seed oils. That question doesn't make sense to me, but is it?
Let's go.
So I
Phil.
don't know
Do you
who
like
wrote
seed
this,
oils?
but
Avoid them. I try to avoid them.
I don't use much hair product, if that's what people are referring to. Unfortunately, with long hair, you don't have to do much at all. But is that related to like biofuels and like the?
No, I think it's just because you're talking about restaurants. You're talking about, are you eating seed oils in your
Yeah.
restaurants or not?
yeah, I didn't get
We
that.
use avocado oil in this house.
Yeah.
Beautiful. Yeah, avocado oil and coconut and olive oil.
That's right.
Yeah.
Bill, I just have a question for you. Could you talk a little bit about the ITC and the adders? I think the industry has less ability to safe harbor, right? And at the same time, we haven't really seen the benefit of it at all either. So
Yes.
like when you look at 24, nobody's doing domestic content, or very few people are doing it. It may go away, but it was not really benefiting the market. I think the bigger thing is the ITC. And what did you say on like the most recent kind of Insider Washington outlook for that? Is that the step down?
Yeah. So my sense is the Republicans want to get rid of the stack, the adder stack. And then you get the base ITC. And then
Sorry,
want-
Phil, when you say adder stat, you're talking about LMI, you're talking about domestic content, you're talking about all those other things. And so keep the
Energy.
base 30%, but get rid of the other stuff of the IRA.
Yeah. But here's I think 2 kind of scenarios, right? One is the ITC stack. Sorry, the ITC requires domestic content, 30%, and they need domestic content. Definition of percentage and of domestic content could change, and so we don't know. And then in that scenario, if the phase down started in 27, 28, you probably would have no ITC adders. Okay? And then the other scenario I'm thinking about is, say the phase down starts at year in 25, then Republicans may allow everything to stay as is, may not require the ITC to have domestic content, but you only have this year. And then it phases down in 26, 7, and to 0, potentially. And ultimately, if you look at the House resolution that was passed last week, they had a 3-page note. In it, on the second page of that note, there's a bullet that said, dismantle the IRA. That's what they're trying to do, right? They are trying to get rid of these credits. Why? to be able to pay for the extension of the tax cut that Trump passed in his first term. And they need to cobble together $4+ trillion to be able to do that. And they're going to try and get tariffs or use tariffs to serve as an input to offset that tax cut as well. Does that answer your question, Chris? Is there more you want me to get into?
Yeah, I'm just curious about the rate of step down. So you think it'll step down down to zero by 2020? Is currently.
Yeah, one of my DC contacts shared, we don't really know, but and we put this in print maybe 2 months ago, 30, 20, 10, 0, or 30, 25, 20, 0. But 0 was in there as opposed to the prior situation, which was 10% minimum, right? So these are dramatic changes that could be happening. Now, a lot of people have pushed back against what we've written and said, hey, you have 18 House GOP members that supported the IRA or elements of it during, like, at the end of Biden's term. And just with the House majority of just one for the GOP, isn't there enough of a red line of defense to support and not change? And Eric Cantor, former House Speaker, was on a panel at a conference in December, and I was there. And somebody asked him that question. He said, there's a new political framework these days. So jobs is one thing, but what's of more importance than jobs is anti-woke, anti-China. And so if they think that we're subsidizing the Chinese modules and so forth that might be operating and sending modules from Southeast Asia, they want to stop that. So he thinks, for example, everybody will fall in line.
So
And
Phil,
yeah, please.
oh, sorry, finish that one. I want to make sure I have enough time to get this question.
He thinks everyone will fall in line. And there's a lot of naysayers against the Trump administration for being able to get a lot of his political appointees, like secretaries nominated, confirmed, like RFK and Tulsi Gabbard and Kash Patel. All those guys are getting through. So there is enough support, certainly in the Senate, to get that done. And ultimately, he thought, I believe others think, that even with a one member majority, that they can get it done.
So I have a question for you, and this has come from other people I've spoken with, but there's a sentiment out there that we're over-indexing on investors, capital markets are over-indexing on the ITC because we're not indexing more on what we talked about prior with the data. So utility rates are going up everywhere. Like, so the demand for solar is not shrinking. It's only going to increase to produce your own power, to save your money, right? That's only going to increase. Another data point, and this won't be popular with some of the people that are watching this today, but if you were to go back, these sales commission usually mirrors the ITC. So that's shocking. But when it went down, we saw the sales rep commission go down. When it went up, we saw it go back up. And so in theory, if demand is still increasing and is high and the ITC goes away, you're still going to have the demand there. You're just not going to have the massive amount of incentive for the door knocker, for example, and other sales orgs to go out and sell it, because now they're not making 30% on the job. They might be making 20% or 15 or 10%. So there are some people that feel like the ITC isn't really a big thing. It's how do we take care of our installers and how are tariffs going to affect them versus the ITC, because the demand is steadily increasing. I don't know if you have thoughts on that.
Yeah, ultimately, you said it. With the ITC, if it gets reduced, then there's less incentive. With less incentive, there is less demand creation. All solar is sold, right, as opposed to bought. And so if you have fewer people on out there knocking doors, then you end up with less solar potentially. So ultimately, the industry will adjust, and power prices going higher is a silver lining and important for the ability for the industry to adapt. But tariffs can come out of left field. This anode AD/CVD could be very adversely impactful on storage prices. There's a tariff that could start in July or sometime very soon. So it's just the uncertainty of it all that causes a little bit of challenge. And then with tax equity maybe being a little bit tight, certainly for likely Nova, but maybe like we were writing it could be eventually tight for others, then, you know, that just is more, just adding more pressure on everybody to be able to perform.
Awesome.
So, Spencer, I know we're at the end of the time here, and I wish I could be a little more positive, but I'm just calling that as I see it, which is
That's what we need.
Washington, D.C. has more challenges coming. But for those in the audience, get ready and stay ready. And I know you've been navigating this for the past 2.5 years, and the strong will survive.
Yeah, the
Yeah.
American dream is starting with nothing and creating something really awesome, and that hasn't come without challenges over the course of the history of our country. And so I think there's a lot of really phenomenal entrepreneurs that are watching, that are out there, that are like, bring it. Like, we're going to keep getting better. We're going to keep growing, and just get out of my way. And so I'm pumped for those groups. We work with a lot of those groups. And so I like the yin and yang we have here of me being the entrepreneur optimist and you giving us a little dose of reality. And I think we're going to have some good conversations at the end of the year and see how it played out.
Yeah. Thank you, Phil. Thank you, Chris. Thank you, Spencer. And for those of you who are joining, we appreciate it. Happening now is our next session, which is policy and regulation, which lines up right with what we were talking about. Policy and regulation, the changing landscape of solar. So jump into the lobby and join us over there. Thanks again, Phil and Chris. Appreciate it.